Welcome to the Dividend Talk podcast, episode 218. Quarter three earnings season in full swing. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DJI. If you want to learn more about us, please visit europeandji.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. What a week this has been.
Yes, definitely. Earnings are in full swing, right? As we just said, as per the title of this show. And I don't know how it is for you, but I really love this season. And Q3 even a little bit more, because it's the last moment before we get all the annual reports. So we can really start seeing a little bit how the portfolio has been shaping this year. And I must say, a lot of my holdings that are reporting are doing really well, which is really interesting to see. Some of the longer term investments that were dead money are starting to pick up again, like Danone, Unilever. And yeah, so that feels good. There's kind of a lot of confirmation bias that I'm receiving this week, and let's hope for next week as well.
Yes. And you can tell that by the stock market over the last, I would say, couple of weeks. It's definitely after going in a positive trajectory, even before earnings, which is always a good sign that something positive is going to happen. And I agree with you that most of my portfolio has been quite positive so far that has reported. Still only 1 week into it. There's a couple more weeks to go, but let's see how we go. There's a couple of nice companies here that we're talking about. Unilever, for example, we get into European, I would say one of the Europeans' most well-known companies. So interested to talk about them and get your thoughts on those. But before that, let's talk about our usual news of the week. What's been on your mind? What's been out there?
Well, generally speaking, there was one news item that really caught my attention, and that was maybe not so much directly to the stocks we own, but Interactive Brokers, but also a consortium of Altor Equity and Partners and Centerbridge Partners. They have shown initial interest in acquiring Saxo Bank.
Oh.
And many of us, they are with the broker Saxo Investor, which is from Saxo Bank. So it's really interesting to see if there will be consolidation in this. I still have a small Saxo account that I inherited from Bink. I moved almost everything away there. I still have really a few euros there. And it will be very interesting to see if Interactive Brokers is taking this over as well and what that would do. Yeah, it may also be the other consortium. But for me, this is very interesting because practically speaking, what you continuously see is that once you find let's say, low-cost broker, it takes a few years for them to build a market. Then they get acquired. Once they get acquired, the fees start being introduced. And this is what is happening all the time. So usually the low fees, they only last for a few years until the company gets the mandate to be profitable. And of course, in the early days, they say like, no, we're different. But in the end, they all start looking for profits off the back of the shareholders. So of course, in my case, I find Interactive Brokers one of the best brokers out there. I'm using it very actively. As we always say, the UI is not so intuitive, But if you look at the white access, the low fees, and all the facilities that it gives, the Morningstar integration, then it would probably even be a good thing for Saxo Bank.
Yeah, I think so. And it's what caught my eye here is that if I read the article you've published, that Finnish Mandatum IO are going to be involved in this, in their financial services company. That I don't know if you remember way back in, I can't remember if it's a newsletter 1, 2, or 3, but someone highlighted this company to us, and it was really. Yeah, they spun off from, let me get this right, I think it's Sampo, or there was a spin-off, but they've really nice dividend policy, growing really fast, if I remember. I can't remember at the valuation at the time, maybe they were growing too fast for my valuation methods, but nice to see a Finnish dividend company in the mix there as well. But I agree with you. I think it's a good opportunity for that Saxo Bank to break into maybe a more European market rather than, I don't know what their offerings are over here, but it's interesting. Will it affect Interactive Brokers in any way? They're probably just a minority stakeholder here.
I've no clue. Well, that has to play out if they get to acquire it. But it's interesting also to hear that Saxo Bank is up for sale. That's what it comes down to.
Yeah.
So that was the first news item. The second one's not really a news item, but I just wanted to congratulate you because this week I went on to Spotify to check something, and I never listened back to our own episodes and such. It's quite awkward still to hear my own voice. But then I saw like, whoa, we have a 4.9 star rating and 280 or so, 272 reviews. And that really was surprising to me. At first I had to check, is it like 4.9 out of 10? But then I noticed, no, it's 4.9 out of 5, which was also really nice. And then I started browsing a little bit with all the other investment-related podcasts around dividend investing. And I was really proud that I saw that we stood out so much. And I put it also on social media. We got really nice comments from the community, and it's quite humbling because we are not focused at this stuff at all. I mean, I remember back in the day once that they introduced some rating, and probably we had 3 or 4, maybe 10 or 20 ratings or something like that. But I thought, okay, so to open up this Spotify app again 2 years later and see this was very, very well, it was really put a smile on my face, right?
Yeah,
because we're not focused on that. We're just focused on every Friday or every weekend publishing and pushing a podcast out, right? And talking about dividends.
I saw your post on Twitter, I think. Yeah, on Twitter or X, whatever they call themselves, that identity crisis they have. But I was really humbled by some of the comments we got, and it's quite nice to hear. And I'm glad that our passion comes across and that we're not just here to try and take people's money or whatever other people do. We're just passionate about dividend growth investing. I did enjoy Irish-born investors' comment, pure Irish, I have to say. And that was, you need to find out where you lost that 0.1 of a rating. I did enjoy that one.
Yeah, exactly.
Thanks a lot for the comments. It means quite a lot.
Definitely, it's a big motivator always because we don't need to record it, right? We would talk anyway, but it's really, it's kind of a testament, I hope, for what our big mission is, and that's really to inspire more people to take matter in their own hands, specifically Europeans, but we have also a lot of other people from the world that are also very interested in what we're saying. It's just this European flavor that we, I think, bring into the mix, and probably the consistency, because we're doing this now more than 4 seasons. And I don't think there are many podcasts out there that have a track record of consistency for more than 4 years.
Kudos to you, buddy. Kudos.
We will be like Charlie and Warren, right? 30, 40 years from now. That's how it will go, right? Yes. That's what I feel.
Yeah, I think so. So on that note, we're all about dividends, and there's been some nice, 2 of note, 2 dividend hikes, 2 nice ones, and the first one is Iberdrola, which is our Spanish utility company.
Yeah, I love this one. It hiked the dividend by 14%, the interim dividend by 14% to 23 cents per share, making it about 58 cents per share on average now. I think almost a 4% yield. It had quite a run up from the low 11 to 13.5 or 14 now. It's a stock that I extensively reviewed in one of the earlier newsletters. I'm very bullish on Iberdrola. I really think they have the right mix when it comes to the business that they operate in, and the trends that are at play in the world when it comes to wind energy, when it comes to government spending to fight climate change. So to see this strengthened by a 14% dividend hike is very comforting.
Yeah, and I think our Spanish community will be very, very happy here. They've been talking about this company long before you and I even looked at it. It was on their radar. So yeah, a nice 14% hike, cannot complain. And then the second company I'm sure you're quite happy with, it's a 7% dividend hike by Starbucks. What do you think? Was that expected?
No, that was not expected for me. I thought maybe a 4-5%. I didn't expect a 7%, knowing that the company is struggling a little bit. So that caught my surprise, actually. But yeah, why not? It's now 14 years of dividend hikes. They can afford the 7% hike. It's not like they're too aggressively hiking. So I'm quite okay with this. The dividend yield is now 2.5%. I already made quite some profit on this one because I tend to buy this one in the high 70s, low 80s. Yeah, so it's already trading too high for me while I was still nicely accumulating. So I would love to buy much more of Starbucks. But I think my first buy was in 2022 for $69. And then this year I bought 3 times something for an average price of about, let's say, $80. So, and I would love to buy more under the $80.
Yeah, and you might get that chance. We know they're restructuring, a new CEO come in there, so you might.
Yeah, but the CEO has some. I think what he did with CMG. What is it? Chipotle.
Yeah.
This guy is onto something. I really like what I'm seeing. He also, how he's talking, how he comes across, effectively is undoing everything that the former CEO introduced. Yeah, so all the stuff we were making joke on social media, everything what McKinsey implemented has been thrown out of the door again. So it's not anymore about communicating the value better about a cup of coffee, because the customers are not understanding the value. Yeah. That BS is really gone now. It's very refreshing to hear to him. And as we always say after that, it's like now it's up to the CEO to, like Jerry Maguire, show us the money. Yeah.
Show us the money. And I think that's a nice bridge into our earnings, actually, because Starbucks is doing good and their CEO is looking like he's the real deal. But I think Unilever is a nice bridge here because they also have got a new CEO who I actually quite like, Hein Schumacher. And sometimes you say never fall in love with a CEO. And we had this with Pat Gelsinger, and that might have been a false dawn. But I get a good feeling of this Hein. He's straight talking, he's straight to the point. They came out with this plan, and I remember speaking on here that the plan was a little bit wishy-washy to me, and it was more kind of internal what they were doing. But we seem to be starting to see a little bit of results there, especially when you look at their volume. And before this, we were seeing a little bit of growth, but it was always price. It was always in and around the price. But for the first time, maybe the last quarter was a small bit, but this quarter we're starting to see real volume growth, which is what we want to see with Unilever. The big surprise for me, and maybe it's not a surprise, is the ice cream division, which they are spinning off early next year. Had the biggest increase of around 9% or 8.1% in around that. Our sales growth was 9.8%, which is quite funny that they're spinning it off when it's growing that fast. Are they trying to drive up the sales and then get a higher premium for it when they sell it off? But overall, the volume growth, there was a slide that was shared on Facebook, but you can see that there was literally Q3 2023, there was none. There was no volume growth. And since then, we've got 4 quarters of consistent increase in volume. So much so that it's actually overtaken by a long way the price growth. So there's very little price growth now. It's all related to volume. So I'd be quite happy with that. I know I sold Unilever, but looking at it, if I was still holding them, I think that would be the most pleasing thing for me, was to see that, because that was my biggest concern. Where was this growth going to come from?
Yeah.
We know they're spinning off the ice cream. North America is performing strongly. Europe is back performing strongly. Latin America is doing okay, and Asia is up around 2.5%. So yeah, overall, I think it's been a good quarter from them. I think we're starting to see what this CEO is about, and I like what I see. It's been dead money for a couple of years, but we're starting. Is this the definition? I think you asked this. Is this the definition of what a real turnaround looks like?
I don't know, but I simply have this question that probably thousands of listeners are wondering right now at this moment in the episode, and it is: do you regret selling them?
No, I don't,
No?
because my thesis at the time was, where was the sales growth coming from? A new CEO came in, he gave his strategy, he bedded in, and he gave his strategy. And looking at that strategy, it was not clear to me exactly what the plan was. There was a lot of nice phrases and words and so on. So I don't regret it. And at the same time, the growth here is only 3.6%. That's not mind blowing. It's not like I'm sitting here blown away by this. It's just where they came from. The growth is nice to see, and we're starting to see that bit of a turnaround. And I think once they spin off the ice cream business and they streamline their businesses down to what they're good at, we might see this propel. But no, I don't regret it.
But the fact that Unilever is starting to get 60 euros in the front mirror view is something unexpected, right?
Yes. Definitely, if you were to look 12 months ago, you would not be thinking this way. But I assume you're a happy shareholder.
Well, I think I see the early signs of what he's up to. I think share price ran already a little bit ahead of itself. How do you say it in English? One swallow doesn't make a summer yet. So I would say that I'm staying healthy skeptical. Yeah,
Healthy skeptical. Yeah. To be fair, it's not one. This is his third quarter of consistent growth.
Yeah, but I think in years. Yeah. So let him do 1 year, and because I do believe indeed that the turnaround is becoming visible now. But let's see if it's not some coincidence. So I want to see some more repetition there. It doesn't really matter for me anyway. It's a full position. I don't intend to buy more. I don't intend to sell. I held it already at the most difficult moment that I was thinking, let's start selling it. I kept on to it. I see now a turnaround, so I would be stupid to sell it. Yeah. But there's been dead money for so long. The dividend started slowly growing again. The share price started a bit recovering. So, yeah, I'll be riding this wave, hopefully.
Yeah. I'd like to see more dividend growth. It's been
of course. That's why I'm quite skeptical. I really want to see. I needed to see also to make up for the last years a little bit, right? So I really need to start seeing high single-digit dividend growth maybe in 2 years from now. That's really what I would like to see.
Yeah, I agree. Nice one. So, who was first on your hit list?
I think we need to talk about a company that has been spoken a lot about on social media, and that is one of the oldest dividend aristocrats, dividend kings in the world, and that is Genuine Parts Co. It's a company we never really speak about, but it released its earnings, and I think it almost dropped 20%. It's a company that's currently yielding, I believe, 3.5% and has 68 years of consecutive dividend growth. For people that don't know this, I think everyone knows it probably, because once you go, there's always a company that somehow pops up. Yeah. It's a company from America, and it is a distributor of automotive and industrial replacement parts. So probably Americans know it better for the NEPA auto parts brand and the industrial services under the Motion Industries. It's a company that exists already for 96 years, and 4 years from now they will celebrate their 100 years existence, which is also interesting because in 28, I mean, how many cars were driving there? It must have been a garage or something like that at the time.
Yeah.
What's interesting here is that 75% of its sales comes from North America. So we're talking here then about Mexico, the US, and Canada. 16% from Europe, except that's without Scandinavia. So they're really present in mainland Europe and the UK. And then 9%, as they call Australasia, which is Australia, New Zealand, Indonesia, and such, that area. So they are operating in 17 countries, and yeah, they have a market cap of about 19.4 billion. What's interesting is at the trailing 12 months, they made around 23 billion. 62% is approximately automotive. And yeah, it currently has a dividend yield of around 3.5%, which will definitely attract quite some people to start looking into it here. But the question is, what happened? Why did it drop so much? So what they really claim is just there's weaker demand at the moment, but also the costs are rising. So if you take that, yeah, weaker demand, less sales overall, let's say, and then a higher cost, then you have just a lower margin. And actually, to be fair, they increased their sales a little bit by 2.5% to 6 billion. So it's really more that the profit went down. So they made 521 million in profit, which is a decrease of 14%. The margin also decreased by 1.7%. So all in all, the EPS decreased by 24% to $1.88. And that's, of course, a significant drop. You can sometimes have some one-offs there. There can be anything going on there. But then to also reduce the outlook from 855 to 660 for the year, yeah, then we're really talking about a 25% haircut in the outlook. So no wonder that the company really reduces the outlook and the guidance. So what is important is that the automotive business brings in the most sales, and it actually increased with 4.8%. It still saw a decline of 19% in profit, and specifically Europe has been a very tough region for the company. So yeah, what to say? They pay $4 in dividends. They're expecting a 6.6 EPS per share for 2024. This company is cyclical, yeah, because you know how it goes with car repairs and such. If there's an economic downturn, first of all, you don't buy a car, so you may repair a little bit of car, but at the same time, you also postpone your car repairs if you can, or your car maintenance. Yeah.
Yep.
So from that point of view, the dividends well covered. But I would have only one watch out here, is that the debt to equity is slightly above 100. You may not see it in the data if you use the typical data basis, because there are capital leases in there that are often not accounted for in the long-term debt number. Yeah, otherwise you get like an 85% debt to equity. So I believe that the balance sheet could be a bit stronger. But yeah, very interesting company for me. I know this company already since the moment I started in 2014. It was always popping up in my radars. I just never had a feeling for it, and I feel that I need to look a bit more into it, because it may be one of those companies that is actually attractive for me. So I will have to do some homework. Maybe I'll create a dividend stock card this weekend, which I can then also release with the upcoming newsletter on Sunday.
Yeah, it's mad when you think about it. It has a 8-year
Yeah.
dividend history, you said. And we very rarely, this might be the first, maybe even second time we've spoke about it on this show. And you're quite right. I remember my early days starting as well. And this was always, when you run your standard screeners, I suppose everybody reads the same books and probably runs the same screeners. You look at the PE
Exactly.
ratio, dividend yield. And this company was always up. But what put me off it was that it was in the motor industry.
Me too. Me too.
And that's really what put me off it. But it's hard to ignore 3.5 yield on a 3.5% yield on a 68-year dividend history. So I look forward to your stock card on that. But another company that's quite similar, not in the car market, but I would say in a similar enough niche, would be Snap-on, which is a company that gets talked about quite a bit on the show after we made fun of it in the early days. And it's quite funny because they had a similar kind of trend to GPC. Their net sales decreased 1.1% year over year. And again, that's down to sales. So we can see that there is some currency impacts, but it's mainly down to lower volumes and lower sales. So, you know, when consumers don't have the cash, they will look for the cheaper tools and they might not necessarily look for the premium ones. In saying that, the operating earnings increased, which shows then that they are doing well cutting costs. So they're cutting costs somewhere along the line. So operationally, they seem to be performing quite well. And their earnings per share was up around 4.2% year over year, which is not bad.
And in this case, the share price popped, with quite some percentages.
Yeah, the share price popped, and it was funny when you talk about the outlook from GPC. The outlook from Snap-on was not negative at all. They were cautiously optimistic, is the words that I will put on it. I quickly browsed. I couldn't see direct figures on what they were predicting, but they were cautiously optimistic that it will continue to see low-digit growth. And I think that's probably the difference in why it popped over GPC. Their sales, their segment sales, again, look, we know their overall sales was down. So commercial and industrial group was down 2.1%. Snap-on Tools Group was down 3.1%, and their repair system was down 1.9%. So they're all kind of similarly down around the 2%. Their cash and cash equivalents decreased by 300 million to 1.3 billion, and their dividends for the quarter was 79 million. Net debt stayed flat. So look, overall, revenues declined. There's lower demand there. But again, still quite a solid quarter for them, considering operationally, at least anyway, they can show that when times get tight, they just cut costs and still have operation margin expansion, even though sales has been declining. So I think that's really the main difference between them and GPC.
Yeah, I like this company a lot. I find it the strongest also among its peers when we would compare it with Illinois Tools Works or Black & Decker.
I think so.
This one's the strongest. I just want it at the right price, and unfortunately it went up even more, so further away from my buy zone. But c'est la vie. That happens from time to time, and maybe that's also therefore a really interesting one, because let's stay a little bit in this space, because let's go to the largest locksmith of the world, Assa Abloy. And what not every listener knows is that I wrote a deep dive about them in the 5th issue of our premium newsletter. Early in November 2023. They were trading around 245 is it crowns? I think so, yeah.
Yeah,
Swedish crowns, yeah. And I called it in that newsletter a unique opportunity at that price. It was trading at a 2% yield. 1 year later, there's literally, from that moment I wrote the article, it's a straight line up. And it's not because I wrote the article. That timing is, of course, very coincidence. Because it also had a few headwinds, like not the best earning report before, but to see sometimes how this goes, right? So these companies, it never goes in a straight line up. If you zoom out, like on 10 years, it may look like that, but there's always like typically I said several months or maybe even years of flattish, and then suddenly poof, 40, 50% up. The stock gets ahead of itself. You see some multiple compression again, so the share price starts flattening off. And next one, like an S curve, you see that often, right? And I think Assa Abloy is really, really a good example of this. Now, if you then look at the performance, maybe what I really wanted to highlight that caught my attention. Did you know that they installed 30,000 locks and handles and cylinders at the Olympic Village in Paris during the Olympic Games?
I did not know that.
So it's really that Assa Abloy really kept all the athletes sleep well at night. Yeah, and it is also the typical sleep well at night stock for dividend growth investors. So it provides really a lot of safety in every dimension that you can think of. But another one also, they have now a technical partnership with Boston Dynamics to bring access control to the spot security robots. Spot security robots one, but Boston Dynamics, there's this company that always gets the creeps out of me. Yeah, they have these real life robots that I can typically see one time as killer robots and the Terminators. Yeah, that you just don't want to mess up with when you meet them on the street. That's Boston Dynamics, right? So hopefully they can bring some safety to that as well and put some locks on it. So when AI really comes to fruition, that they don't get any mad IDs, those robots. Generally speaking, sales have been slightly increased year over year by 1%, but this is the nice beauty of it. If a company is able to increase its margin, then you can really see a nice profit growth. So its margin grew by almost a percentage point, but this leads to an EPS growth of around 10% in this case, which is really, really nice. What is important, though, what I would like to say is that they are continuously acquiring companies. So if you look at almost the last 1.5 years, the sales growth that they had was almost purely by acquisition, not necessarily by organic growth. And I think investors need to realize that. You, of course, also want to see underlying organic growth into sales, and that has been effectively flat.
Yeah.
So almost everything is by that. Now, why was the margin up, right? First of all, just they have some lower material costs. Where do you hear that today? We just had a few reports where costs are up, right? A weaker US dollar as well. And finally, the large acquisition from HHI is starting to give some cost savings and therefore some, let's say, some synergies. Yeah, and that was also what they were predicting or are looking forward to. So all in all, I would say sales-wise, nothing special. I think they could do better, but lots of cost control and therefore, again, a nice bottom line earnings report.
Yeah, very nice bottom line earnings report. And I'm just looking at the share price compared to the adjusted sales growth slide, and it's almost inverse. When the sales growth was strong and kind of up to like flattish, share price was dropping, and then we have virtually 1, 2, 3, 4, 5.
But I would, that's true. But I would like to really argue that there was a multiple contraction going on as well. It was so overpriced at that time. So I think that was more at play there, Derek. But to your point, if you would overlay it, it looks really skewed.
It looks good, and the weaker USD might have helped them a lot over the last quarter. It looks. But I have to say, nice article from you at the time. I remember you writing unique opportunity. I didn't take you up on that word. My conviction was not as strong as yours, but happy.
Well, I didn't buy them myself either at the time because the yield was still too low for me, 2%.
Yeah.
I was considering buying some, but I never pulled the trigger. So, and of course, now the price is up and you could say, okay, you take your confirmation bias from there, right? To some extent, that's true. But I still genuinely believe that at this moment in time, the shares are too much overvalued, and I'll probably get another opportunity again. And maybe then I will briefly nibble in.
Yeah. Nice. Okay. That's four nice companies. I think we might finish off on one I haven't heard you speak about in a while.
No,
So
I want to speak about IBM.
might ask you about that.
Currently, it has a dividend yield of 2.9%. And we have to talk about this one because am I the idiot here? I was saying when the share price was around 110, 120 that I wouldn't touch it. Where is it now? In the 200s. Yeah, so the share price nearly doubled. So what do you think?
I mean, you can't judge it on share price. We always say
Good,
don't look at the
good,
share
good,
price.
good, good, good.
Can't
Thank
judge it
you.
on share price.
Thank you, thank you, thank you. So first of all, in this quarter, they made a loss. Yeah, GAAP earnings. Non-GAAP earnings, they made a profit of $2.3 per share. Now, what is this time with these clowns? They have the GAAP results include the impact of a one-time non-cash pension settlement charge of 2.7 billion related to the transfer of a portion of the company's US defined benefit pension obligations and related plan assets to a third-party insurer announced in September 2024.
Okay.
So I think UPS had something similar last year or 2 years ago.
Around
I mean,
pensions, yeah.
you know, they have so much, they still have 10 billion on the balance sheet, right? In pension obligations. These companies just need to I said, properly deal with their pensions, yeah. And they're now doing some bookkeeping, take it out of the earnings. But what I get down to is I updated my graph again, and there's a 50% gap between earnings, trailing 12 months, or 33%, depends on how you look at it, right? There's a gap 50% upwards, but 33% if you put them besides.
Yep.
In between the GAAP earnings and the non-GAAP earnings. And it is really insane, Derek. If you look at it, I'm looking here at the stats. In general, it is really insane because let me do the calculation here. We have in general a gap since 2011. The GAAP earnings and the non-GAAP earnings had a 30% gap. Most notably, really since 2017. So in the last 7 years, continuously they are financially engineering. It's unbelievable. Now it's pension obligations, but you can't have 7 years of one-offs. Yeah, in those 7 years, since 2017, they made GAAP earnings $54. Yeah, 54. Non-GAAP earnings 87. This is so much. How many one-offs can you have?
Well, if they're going to pay out 2.7 every time for pension settlements, they have at least 3, 4 more.
Yeah, but there's so much financial engineering going on. And okay, let's look at the earnings, because the share price really in the let's say since March this year went from 125, 130 to 215 right now. And I wonder where it comes from. I really don't understand it. Software revenues, 6.5 billion, up 9.7%. And this mostly because of hybrid platform and solutions that are up 10%, mostly Red Hat, yeah, the acquisition they did.
Yeah.
Consulting, who wants IBM consultants? Revenues, 5.2 billion, down 0.5%. That's where probably all the pension obligations go towards too. Infrastructure, the old metal that they still have, revenues of 3 billion, down 7%. The good thing is, to the credit of IBM, the only good thing I think they did in their last 10-year history is the Red Hat acquisition, because it's just driving the company forward. The software revenue compared to infrastructure is now also twice as much. So, and this comes at a higher margin, typically this business, so they should be a bit better prepared for the future. But IBM's free cash flow was 2.1 billion, up by 400 million compared to last year. and they returned 1.5 billion. So you're really talking still about a 75% or so payout ratio here. Let's say 72% to round off positively for them. I mean, it's a high payout ratio in a given quarter.
Yeah, I think so.
Yeah, on the free cash flow, and then technically making a loss, but of course they report everything also non-GAAP because it suits them better. I mean, I'm even looking in the whole history of since 2011, it never happened that GAAP was higher than the non-GAAP. It's all the time. I mean, yeah. You can hear me talking, right? But this, as long as this company is so much financially engineering and has such payout ratios, I only see red flags. And of course, they can survive. It can be in a few years. It can be a dividend king, maybe. Who knows? Yeah. But how long? I mean, that's the benefit of a slow compounder. Yeah, it takes many years before this company really goes to the trash, and they may have a way out. But then you are looking in their earnings report, and you would think that AI is the boom and everything. Data and AI up 5%. And then you see the Microsoft and everything, what they are doing with their cloud services and everything, more than 20%. This company doesn't even come close to it. Yeah. The consulting business is that money. The infrastructure is, of course, declining, and the cloud is making up for it a bit. But yeah, as you can hear, I'm not a fanboy of IBM.
Even if you can ignore the financial engineering and make a case for the genuine 7 years of one-off charges, if you could do that, I mean, with dividend growth investors at the end of the day, and the dividend growth is abysmal. It's sub 2%, I can't remember, 1.6, 1.7%, in and around that. You're not getting much value for your money with this type of company. If I held them, I'd be looking to sell them at this price, especially after the share prices jumped so much. I think they're trading at a 21 PE, which
because
I mean it's clearly overvalued. There's no real dividend growth. I don't know.
Since 2019, they've been raising the quarterly dividend with 1 cent each year.
I mean,
it's from 162 in 2019 to 167 right now.
Yeah, they're just token raises is all they are, just to keep that streak going. But yeah, if I owned them right now, I'd be probably looking to get out on a high. Take your total return. If you're total,
I would do that as well. I would probably take the cash and deploy it elsewhere. But there are quite some people that are still enthusiastic about IBM. I'm sure some of the listeners as well. I'm sure they will wholeheartedly disagree with me, and that's good. Yeah, because you really can't borrow conviction from each other. And if you have the conviction, well. And at least the share price is proving me entirely wrong. Yeah. But underlying, I just don't see it. And kind of maybe I wish that it was different. Yeah, because then IBM would have been a big value. But no, I can't. I'll stick to Microsoft.
Okay. Yeah, I thought you were quite tame there. I was expecting a lot worse. I didn't read the figures until you spoke.
Yeah, but I have been calling the CEO a priest and everything in the past, like of a small village. Yeah, I haven't changed my opinion there. I just mentioned them a clown. I try to not insult CEOs too much anymore. Who knows? Maybe they will be a listener. They also need to do something with their cash.
Yeah. Okay, let's move on to listeners' questions. And the first one this week is from Hussein, and he's asking us, how do we allocate our time every week for all our activities? So he's talking about reading the news of the week, reading articles, quarterly reports, our newsletter, podcast preparation. How do you find the time, and do you find it hard?
I don't find it hard. Sometimes it puts a little bit of more pressure on me because I was maybe short in time. But generally, I mean, it's easy when you have when you follow 1,000 people, mostly on FinTwit, and also when you have the Facebook group. The news is always in your face. That's the nice thing on social media. You can create your own little bubbles. Yeah, so
Yeah,
following the right people really makes all the difference. Our Facebook group this week was also very active, so I just need to open Facebook and I'm caught up. Yeah,
yeah,
which is the nice thing about that. When it comes to time, probably I spent a lot of time on it, but it doesn't feel like time. I mean, others are watching The Bold and the Beautiful or any other soap in the evening, yeah, and I'm reading a quarterly earnings report. Yeah,
yeah,
that's the main difference. I spend a lot of time with my kids and my wife as well. But for instance, if my kids would go to bed at 9 and my wife may at 10, then I still have an hour to look up a few things, right? So yeah, no, it's just a hobby.
yeah,
Very
yeah.
passionate about it. And for you?
I agree. It's not that difficult. There's times when we are busier than others, but I think that's the great thing about being part of a team and a partnership is because there's some weeks you pick up some of the slack for the newsletter and the
Yeah,
podcast, and some weeks that I have to, and I think that makes it a lot easier. And I think we've been quite flexible over the last 4 or 5 years working around. And like you said, our own little bubble, our community keeps us up to date. I mean, I just have to open up Facebook half the time. The Unilever earnings are there. There's
yeah,
lots of stuff there right in your face. So it's not that hard. When you're passionate about something, it never feels hard.
yeah. And we are quite productive, I must say, because we
Mm.
build a lot of routines over the years. Yeah, I remember the first time when I was editing the podcast, how much time it cost versus now. We build a lot of routines and automations over the years, which also really contributes to this. If we would needed to do everything we do now, like how we were doing it the first time when we did it, yeah, that would not have been possible.
No, no. But I think we tried to be perfect at that time. Now, if we make a mistake, it's like, screw it.
Yeah,
let's,
true.
let's, let's roll it. Let's roll
Yeah,
it. Marcus, he's asking you, what car did you buy?
I bought a Hyundai family, a typical family car. Good value for money, the Hyundai. I can also recommend the Kia. They are built in the same factory, on the same, by the same, yeah, probably by the same factory.
Yep. Nice. Bass has said to us, here's something to be angry about. Germans will now be required to pay capital gains on ETF/stocks if you hold a value greater than 500,000 and you plan to leave the country. What what do you think about that? I mean, I'm from Ireland, Bass, and we have ridiculous capital gains on ETFs. We have this stupid deemed disposal rule, so I don't feel sorry for you. I'm sorry.
Yeah. But I think they are afraid that Germans will leave the country en masse, right? With
Yeah,
all that's going on in the country, so they just start taxing people that want to leave the country. It's insane.
it's crazy. It is actually, like, when you think about it, it's crazy, and it's almost like a form of stealing wealth. And if they do it in Germany,
Yeah,
we know Germany's kind of the heartbeat of
yeah,
Europe. So if they do it there and it works, you can see Ireland will do it, France
yeah.
will do
Because
it.
what they do now is they really screw you up. They
Yeah,
really lock you in now. You cannot, for instance, what happened in Scandinavia. I think we saw that the other day. They started taxing the billionaires, and then the billionaires went just living somewhere else in another country that was more tax advantages. Yeah, so overall, the IRS in one of maybe it was Norway, I don't know which country, had even less tax income. Yeah, and I guess Germany sees that coming. So probably this is a heads up to all those people with more than 500,000 invested that tax hikes are coming over the next few years.
yeah.
It is just screwing you up and trying to lock you in before they screw you even more.
But I'm wondering then, in Germany, do you have to declare your portfolio if you're holding stocks and you don't sell them? Do you have to declare that? Um,
I guess so. I guess so.
I find
Yeah.
that quite strange. And we don't in Ireland. I know we have to declare our ETFs every 8 years, but if I hold stocks, I don't have to declare that I hold them unless I sell them or
Yeah.
I receive income from them. But yeah, all this is like legalized
Theft.
stealing.
Yeah, no, it is. And I think it's a worrying trend in Europe, how governments are trying to more and more slice off, let's say, from the people that are building wealth. Like we're grinding it, and then to know how much tax I already contribute, and then because I had the right discipline later, I get punished for it, and
Yeah.
need to give my share of the hard-earned money to the people that were maybe not, how is it, postponing their expenditure, but straight away went buying all the stuff they wanted, and then later hold up the hand so that they benefit from me. I find that it's not a fair society like that.
Yeah, and I think the comment Bass made anyways is correct. It's a financial trap that punishes you if you leave the country, but more than financial, it kind of burdens you to stay in the country as well. So I don't know what the capital gains tax is. I don't know how much it is, but if it's like Ireland at 33%, it's a significant portion of money.
Well, if I would be a German, I would literally wait until my wealth would be 499,999 and then leave the country on that day, like just out of a pleasure, giving a big middle finger there to the local tax office there. Like, screw you.
But worrying signs for Europe there, I must say.
Yeah.
Sebastian, if you were in your late 20s, to be in my late 20s again, would you go with a 2.75% dividend yield as a criteria for dividend growth portfolio? Or would you build your portfolio mostly with lower dividend yield but higher dividend growth companies?
It depends more on when you want to be financial independent. Yeah, I need this kind of 3.25% on average and 6% on average dividend growth to be able to retire in 15, 16 years at a 50% savings rate. That's kind of the math. Yeah, so it really depends on the math you do. I would say if you're in your late teens, like 18, 19, and you start, and you think like, well, you don't think like that at that time. At least I for sure didn't.
No.
But let's assume that you say at that time, very hypothetical, I want to retire when I'm 40. Yeah, then you kind of have 20 plus years. Then you could probably afford a lower yield. But if you really want to do it in 15 years, most of us in the late 20s or in the early 30s, when I discovered it, it must have been 31, 32. Yeah, then what time do you want to be financially independent? That's more the question. You need to work backwards and then adjust your yield expectations to that as well.
Yeah. But if you don't mind working till 40 or 50, then of course you'll get higher quality companies. That
depends on how you formulate quality. Yeah, you can also get Evolution AB. Is it a high quality company? Maybe. Some of the highest quality. I bought Microsoft at the time at 2.75% yield. So I'm not a big fan of saying high quality when it is low yields. I don't necessarily would like to make that equation, Derek. I find that actually quite a tricky one.
Yeah, no, it's not a blank statement saying all of them, but typically those that have low yield with high dividend growth sustained, like your Visas, your Microsofts.
Yeah, okay. They are usually in a certain growth curve. Yeah.
Yes.
Yeah.
David has said, is the stock market totally overpriced? And would we now be better taking some profit, getting out, and then reinvesting back in after the drop?
I think the stock market is indeed overpriced. Already since I started investing in 2014.
It has been overpriced, but every year. I remember Mike. We had Mike on the show, Mike, the dividend guy, and he spoke about how it was overpriced. He took out that was it Mike that took out the loan and paid that lump sum into it. At the time, everyone thought he was crazy because the stock market was so overpriced, and it's more than doubled in the time that in that time. So yeah, look, it's a hard one. Time in the market is so tricky, but like as European DJ always says, it's a market of stocks. So there's always something undervalued. out there. So I would not personally be doing that because I cannot time the market. And if you can, David, you could potentially make a lot of money, but there's a lot of risk. There's a statistic, and I think you shared before about missing the 2 or 3 largest days within a year and how much that impacts your portfolio. And that's what you risk, basically.
Yeah.
Mick has said, with the rebalancing option on investment pies on trading 212, should it be done often, or am I cutting the growth of my stocks that are doing well and just loading up on weaker performing ones?
I don't even use the rebalancing.
Yeah, me too.
I just let my winners win. Yeah, because you risk also to roam off your winners and pour it in the weaker performers there. And at the size of the pie that I have in trading 212 for the European Noble 30 index, it's no, I find it a little bit, again, penny wise, pound foolish. I would do that maybe if your entire portfolio is in a single pie, maybe I would consider it, but actually I've never even rebalanced my own dividend portfolio. I have my target goals, my target diversification in the portfolio, like tier 1, tier 2, tier 3, tier 4. I still have that, but it is, I guess, more about how much money I put at acquisition, more than how it will look like after many years, although I see it naturally growing into it as well. So there's not too much big of a delta.
Yeah.
But I don't see really a need for rebalancing. I mean, then, okay, I'll take a little bit out there, put it there. It feels to me, then you get the capital gain taxes and everything. I don't see a need for it.
I think it depends on the size of your portfolio. If you have a relatively large portfolio and you're overweight in some of the companies and you don't want to be, then that's fine.
Yeah.
But if you're investing monthly and have, I would say, a relatively small portfolio like my own, I don't think it needs to be done that often.
Yeah, true.
In my opinion. So, and as you said, there's always tax disadvantages with buying and selling often as well.
It has to, I guess it just has to do with your toleration for risk here.
Yeah.
Tolerance for risk.
But you can always go into the pie and adjust the percentages of each individual company that you want to own. Instead of rebalancing, you can redo that artificially, say, and get more of the companies that you want to own instead of putting it into some of the companies that are poorer, in inverted commas. Akira has asked us about sustainable investing for the future. They are asking this because many of us want to retire early to escape corporate life, but still rely on those companies for income.
Yeah. I don't know if sustainable investing here is meant more like not buying tobacco companies and such.
I'm not entirely sure what that means, but yeah, it must be something around that. Maybe it's around investing.
So generally speaking, I prefer to hold companies that are doing good for the world, and also are able to generate profit for the shareholders. So I really believe in this triangle of people, planet, profit. What I often see going wrong with the companies that are focused on sustainability, they focus on people and planet, and they totally forget about profit, or profit becomes an afterthought. We saw that at Danone with the Emmanuel Faber, the former CEO. We saw it a bit with Unilever as well. Yeah, too much focus on sustainability. So that's what I more have an issue with. If it is all in balance, I mean, for instance, Iberdrola is for me a nice example of a holding in my company, in my portfolio, which is kind of a play on the sustainability. Yeah, but it never at the cost of shareholder return. That's what I don't like. So yeah, and for instance, also Shell, people won't believe it, but them being so big in natural gas is actually really helping society to move away from oil. Yeah, and most people don't realize that. So is that then a sustainable energy play? Well, pension funds don't want it because it has oil in the name. In my case, I find that a sustainable energy play. Thirdly, I believe that every corporate has a footprint on the planet and society, which is probably not necessarily net beneficial. And if we talk about pharma, we can talk about drug prices, we can talk about oil and gas, about CO2, we can talk about sugar and consumer staples, and diabetes. Yes, so I think there are no stocks that are clean from sins.
Yeah, I think so. We went through my portfolio, I'm seeing now, but I think sustainable investing is more and more popular, and I think the younger generations coming through are more in tune with sustainability than when we were growing up. But I
Yeah,
think
but they are also being greenwashed
yeah,
a lot, and I hope they get to understand that better.
yeah. But I think at the end of the day, it will all boil down to returns, and sustainable investing will be okay
Yeah.
once the shareholders are making returns. Because we all invest for money at the end of the day.
I think if you can have less waste in your whole process, if you can spend less on heating because your buildings are more efficient, and you can do that in an economical way, I think shareholders would be pushing so hard for this because it would lead to cost savings and therefore more profit. If you can have lighter packaging, if you can have packaging that doesn't require so much waste and paying for the waste, come on, which shareholder doesn't want that if it has also therefore an economic benefit?
Yeah, yeah, because they benefit both ways, and you can price that into your return because your savings is
Exactly.
an artificial return of that. But
Yeah.
that's what it will boil down to at the end of the day.
Yeah.
Once there's money being made or saved, then shareholders' sustainability will be okay. But if it's not, then people will turn to unsustainable methods to make money, and that's my feelings. Philippe has asked about the UK-based company that I mentioned about investment trusts. We will link it in the show. I've tagged myself here, but it is called the AIC, and it is a fantastic resource for investment trusts. It lists out everything you need to know: leverage, dividend policies, what the funds are about. So, yep, we will definitely link to it, Philippe. Christian, what is the best site for tracking financial performance with good graphs and is free?
I think at the moment FinChat.io.
Yep. Yeah, I think so. I think that's probably the best. JVDK. I know you don't invest in dividend ETFs as European, but the TDIV ETF by Van Eck is pretty good yield and growth. What's your take on it?
So actually, I discussed this this one on one of my blog posts on European DGI, where I have the 15 dividend UC ITS ETFs compared, and it's actually one of the 3 out of those 15 that if I would go ETF, I would consider. Hence, it's really for me one of the better ones. So I think he's spot on there. Although I would like to give a watch out that the 2024 dividend is probably lower than the one from 2023 because the year-over-year quarterly dividend was also lower. I expect the dividend in 2024 to be somewhere in between the ones of 2022 and 2023. So in 2022, they paid 156 in dividends. In 2023, 180. They are now, after 3 quarters, on 134, and usually they pay something around 25 cents in the last quarter. So it should be somewhere around 160, I think. But just please, people should be aware that this ETF doesn't exist that long, since, let's say, 2016, 2017. But in 2017, it paid €1.13 in dividends. And if it comes now out on 160, there was just like 47 cents growth in dividends over those 7 years. It's really not a lot. And then also in 2020, it had a 20% dividend cut. during COVID. So when you really think about dividend growth, it's a tough one. It's maybe growing by 5% annually if I'm optimistic. And if you take the setbacks those years out. So but yet one of the better ones, I believe it's yielding somewhere north of 4%.
Yeah.
In that case, I would say buy ASR. Yeah. I know it hasn't got the same diversity, but you get a better yield and a better potential on dividend growth. So
Yeah. As an Irish citizen, if I was to invest in ETFs, I'd probably go for ones where, first of all, the dividend is accumulated and not distributed because of the tax. And then looking at the capital appreciation from this, it looks actually quite nice. So
the capital appreciation did really well. That I forgot to say. I think it more than doubled over that same time. So total return is probably quite good. For the dividends, while it's called the developed markets dividend leader, and it has there all those stocks in there like Pfizer and everything, Verizon in the top 10. From a dividend point of view, it doesn't look that good.
Yeah. And remember, we're income investors at the end of the day, and you want income.
Yeah.
You want reliable income.
Yeah.
That's the key. Philippe is back with another question about AI. And he's asking our thoughts on AI in investing. And he's not talking about the AI bubble or companies, but he mentions that a lot of things have been said about AI taking jobs from programmers, media content creators, podcast hosts. Do you see any fund managers being replaced by AI in terms of market analysis? And how do you think AI will change that area of investing and analysis?
Yeah, before I answer that one about podcast hosts, you know that you can now just ask ChatGPT to write the whole podcast narrative for you, and then is it Notebook LM, I think, from Google, one of those, and you can just generate a podcast based on that.
And a voice will speak it.
Yeah. That's why we need to use terms like priest and clown, because I think there are too many of those woke people or socially correct people working in those companies that they wouldn't want to insert that there, I think. So I think that's how people can still separate us from the AI, these terms.
Do you know what? If you listen back to our first episode, the pilot episode, you probably think we were AI. so stiff and how we were talking.
Yeah, but I think the AI will have it hard to go berserk on IBM triggering me or something like that. It's a question: how can you trigger an AI persona as well, right? With a certain ticker symbol.
I might try that at ChatGPT and see where it comes back with. But I think this is a very interesting question, and I suppose there's lots of different perspectives, and you could have a whole show on this. But we talk about efficient markets, and how efficient are they? And we know there's always opportunity, and as long as you have humans that are doing analysis, there's always emotion, and maybe not so much looking at the underlying figures all the time. They might know people in the companies. If you have AI doing that, then they're not talking to the CEO, they're not talking to the CFO, they're not talking to anybody. They're looking at the numbers. I think you have a much more chance of an efficient market, because then people will know, okay, this is done by AI. They're predicting it should be trading at 21, it's trading at 18, and I think it would do more harm to the market. I'd say it would take the growth out of the market, and it'd be a lot more efficient than what it is, in my opinion. But I don't see
I can see it happening, AI. I think there's already a lot of robot trading happening. There is. What I could foresee, and of course from today AI can go into multiple directions, but what we can clearly see, for instance, is the impact that index investing has on the stock market.
Yes.
There's so much inflow that even if companies are not so well managed, just because that they are in the index, there's always a buy side to their shares. Yeah, and I think that's also one of the reasons why you often see stocks not being close to the valuation, because it's just being part of an index all the time being acquired. I could see something the same here with AI, that if AI and index fund investing maybe start dominating 80% of all the transactions in the world, it may be much more harder to find these opportunities because they will be trading at places where we may not be interesting. So I actually think that it may start bringing more and more stuff to the norm, but at a higher end, which makes our investment philosophy potentially harder. I could envision something like that.
Yeah. It will also put all these FinTwit traders who smashed the S&P 500 year on year by double-digit numbers out of business, I think, because that would be virtually, I would say, impossible at this rate.
Yeah.
I think, look, as I said, I think it would make the markets more efficient. I think in terms of value and total return, that would be harder. But from a dividend growth perspective, I think you would still have some opportunities there. I would think.
But it would be interesting, right, to have an ETF that is based on an, let's say, a proprietary LLM, large language model there.
Yep.
That will do, well, maybe not even the LM, just pure the AI that will really, that on that proprietary AI, they will just do everything and you pay a low expense ratio. That would be very interesting. And to see if it is volatile or not, that would be so interesting to see.
Trading without emotion as well, which would be also.
Well, that's the question. Maybe AI has emotion. We are just not able to detect it.
El Cuba has asked our thoughts about pharma companies in Europe, such as AstraZeneca, GSK, Bayer, and Sanofi.
Well, those are a lot of companies, but I think Sanofi is really the diamond in here. A stock that was not doing so well for quite some time, always then trading at a nice 3.5% to 4% yield. And then they did the deal with Regeneron and poof, one of the best performing companies. I'm not a fan of GSK, Bayer also not. You know why? AstraZeneca, it's a tricky one, AstraZeneca. But then we have also Novartis and Roche. So I would say just Europe needs to be proud on the pharma industry that it has. It's one of those industries that we are really having a strong presence in the world compared to many of the other industries that have been gone to China or wherever it is.
Yeah, I agree. Wolf has asked us about our opinion on Nestle. New CEO, more or less the same strategy as Unilever. He says the positives are the dividend is safe. The negatives are cash flow doesn't cover dividend and buybacks. So, yeah, I agree. And also high debt. So I think we spoke about this a couple of times. They have lots of currency headwinds as well with the Swiss franc. I don't know much about the new CEO, but you're right. Cash flow doesn't support current dividend and buybacks. And actually, I think they use debt to support that, which I'm not a huge fan of. It's usually a red flag for me. It's also been growing at a very low rate as well. So it's a company that I don't even look at a whole often. I just kind of ignore them, even though they're one of Europe's longest dividend streaks, and you want them to do well. But yeah, I'm not a fan of the debt. I'm not a fan that they can't cover dividend and buybacks, yet they still do it consistently over the last few years. And I'm not a fan that the growth is quite minimal. So a company I stay away from. Bogdan has asked us about Altria. It still has good free cash flows, but on the long run from now, can it maintain the dividend and have any growth? Thanks.
Time will tell. Will there be still money to be made in the tobacco industry 10 years from now? More than maybe even today from a net EPS point of view? I think so. I really think so.
It depends on non-combustibles.
Exactly.
That's what it boils down to. There's lots of unknowns, regulations, new products, how that market matures, who has the upper hand. It seems British American Tobacco has at some point, and Philip Morris comes in, and there's still a lot of ground to make up there. So, yeah, I think in the short to medium term, it has a high yield. Cash flow is okay. They can support the dividend. Low growth in the dividend, well, lowish growth. But yeah, 10 years from now, it's so hard to predict with
Yeah.
these companies. So think 5 years with these companies, not 10. Jeremy has asked us about our thoughts on nuclear power and companies that could benefit from it.
I have the only thoughts I have is that I read that Microsoft and Amazon want to have investor in their own nuclear plant or something like that. But I'm not familiar in this in these kind of businesses, so I can't say.
Yeah, I don't know too many businesses on nuclear power. I know as a power source, it's probably one of the most efficient and can be cost effective, but it's also one of the most dangerous, and that's where the problem is. And it's hard to know. It's hard to know. There's pros and cons on both. I know when I was back in college and we were doing renewable energy, and nuclear was touched on briefly, not a lot because it's not the most used, but there's a lot of positives to it. It's just the negatives to it can be deadly disastrous, and that's the issue, and it has to be managed quite well. But no, I don't know too many companies on that either. So, our question. And Kaelan has asked us about investing in carbon emissions in Europe. There is this KRBN, but it's not an ETF that Europeans can invest in.
Yeah.
So,
I don't know.
I don't know either. I think carbon emissions would be a hard one to invest in, and I know countries can buy and sell carbon emissions between them, and one don't meet their criteria, and one has exceeded, and they have some emissions left over. They can trade them to other countries, but I don't know if investors can do that. But yeah, it's not an area I would like to invest in either at the moment. David Andrew has said he's looked at legal in general and some renewable stocks like Electricity, SSE, and Green Code UK Wind. As the new UK government says, it wants a big renewable future. So these stocks look like a good bet. I think I said something like that on the show when this government went in, Labour government. They are usually pro renewable. And honestly, Green Code hasn't got the uptick that I thought it would in that time. But in fairness, I don't really care about the share price, so it hasn't bothered me. But yes, they should do well under this government. Michael has asked us about our thoughts on Amazon as a potential future dividend payer. What do you think?
I think that's possible. We have seen Google, Meta, Microsoft already there, Apple already there. So I believe that Amazon is really, really next. I just don't know why. I don't find it obvious yet. But of course, Amazon as a company is amazing. What has been able to establish, the power it has. Not just, I mean, it started kind of like an online bookstore, right? That really was started off with, and then now having they have their own shipping company, right? Air freight, everything. So it's a competitor to UPS and FedEx, as well. Yeah. Let's not talk about even AWS, where most of the profits comes from. I mean, it's everyone knows the Amazon flywheel theory, and it would be awesome to have this company paying dividends.
Yeah, I could see it paying dividends, and if you hold it now as part of your growth portfolio and it changes to a dividend stock, then that's a bonus. So I think when it does do that, it means that their fast growth stage is over, and they probably they're consolidating and becoming a more mature company. But yeah, I think eventually it will become a dividend payer, but who knows when. And Lucian has asked us the last question of the day, and he is saying ELV or UNH. Which one would you
own? Probably none. I'm not a fan of these kinds of businesses in the States, so no.
Yeah, look, the healthcare, health insurance, and it's tricky in the States. I don't know enough about them, so I'm the same.
Yeah,
nice one. Okay, that's the end of the questions. So thanks a million to all the questions. I think the AI one has triggered me a little bit. I'm curious and I want to do a little more reading about stuff like that. But again, thanks to all the questions. Really appreciate them. And we will see you all for more earnings this day next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.